dear President, and dear participants. It's always very nice to see this community, the ESRB, the macro-prudential community, but also colleagues from central bank supervision. So it's good to see you here. This conference is about new frontiers, and I open up another new frontier, which I think is one we're all thinking about, and that also worries us at times. But it's certainly one we need to address, which is geopolitical risk. So the question I would like to discuss with you: what do geopolitical risks, heightened risks, mean for supervision and also for the interaction between microprudential and macroprudential supervision. And if you think back more than 10 years ago, I think it was in 2011, although the legal framework was in 2010, but in 2011 the ESRB met for the first time. To some extent, the global financial system was still recovering from the global financial crisis. The European sovereign debt crisis hadn't fully developed. But at the same time, I think there was also this spirit that we have a new policy area with macroprudential policy, so we're all designing the new policy tools. There was a lot of institution building in Europe, and there was also this confidence that international cooperation would work. So there was the Pittsburgh Summit in 2009 that decided on a whole range of regulatory reforms. Now, if you think where we stand today, to some extent the world looks very different. So on a positive note, there's lots of evidence, and also people in this room have contributed to gathering it. There's lots of evidence that the reforms have actually worked. So the financial system is safer now, better capitalized. There's higher liquidity buffers. We do have new institutions in Europe, which I would claim are working well. The SSM, the Single Supervisory Mechanism, the Single Resolution Board. We all know that there's more work that needs to be done, in particular when it comes to resolution. But the system is working, and we have 1 decade of experience with macroprudential policy. So this is really, really an achievement. But at the same time, we also read and see it every day that the foundations of the international order, on which also the agreement of the Pittsburgh Summit, for instance, was built, that this is becoming shakier. We have protectionist policies, which sometimes give the impression there's a lack of clear commitment to multilateralism, to strong global trade agreements and cooperation frameworks, and clearly I think we're heading to a period in which there's heightened geopolitical risk, with more uncertainty, with more volatility on markets, and we need to prepare for that. Now, at the same time, memory of past financial crises is fading quickly, and I think we're all familiar with the work of Reinhard and Rogoff, where with the very intuitive title, this time is this different. So this just shows you the history of financial crises that have appeared over history, and clearly, when you listen sometimes to discussions about the regulatory framework, there's more and more people calling into question whether the regulatory reforms may have gone too far, come at the expense of competitiveness. So that's one part of the discussion. And then also we need to see that the shocks that the financial system and also the real economy has been exposed to very recently, the COVID crisis, the energy crisis, have also been buffered by fiscal and monetary policy. So this memory of what happens if anything goes wrong in the financial system, this is a little bit further away for many of us. Of course, also due to the good work that many of you in the room here are doing. And I also feel that progress with new regulatory initiatives when it comes to NBFI is somewhat slow. So what does this all mean for us, and what does it mean, of course, first and foremost for the banks who also have to manage these risks, but what does it mean for supervision? And the 3 points I would like to make here is that, and they're quite obvious, but I think it's really important to be reminded and also to actively to work on this agenda. The 3 points are that first, we need a framework. We need a framework of how we want to look at the known unknowns and the unknown unknowns, so all this uncertainty that's around us, and I will make a suggestion that we have developed in the SSM of what this framework could look like. The second point is that, and also, I mean, this almost goes without saying, but we need close cooperation between micro and macroprudential policy, and supervision, oversight. So I sometimes still hear people say, well, there could be a conflict. Of course, if we're not doing enough in one space, then it might be that there's a conflict. But I think really we complement each other. And I will elaborate on that also a little bit. And we really need, in particular in this area where we have a lot of uncertainty and really global risks and uncertainties we are facing, in particular there, we need this cooperation. And again, also almost goes without saying, but geopolitical risks are global, so we can't deal with them just at the European level. We need international cooperation and coordination, and I think in that sense, it's also extremely important that we don't dial back on Basel III. That would weaken the resilience of banks and also undermine trust in global coordination. So let me be more specific what we mean with this framework for addressing geopolitical risks. And as any good framework, it needs to start with some definition because there's many ways of thinking about geopolitical risk, and we borrowed one which has been published recently, which is basically the threat realization and escalation of adverse events associated with wars, terrorism, and any tension among states and political actors that affect the peaceful course of international relations. So this is relatively broad, meaning that geopolitical risk can have many manifestations, terrorist attacks, the president mentioned, cyber attacks, trade disputes, sanctions, heightened political instability. And the important thing to note is that these risks, these events, they can either be very slow burning or fast burning, and this makes it so difficult to predict, and they have such an unexpected, unpredictable nature. And also, yes, if you followed the work of the SSM and the ECB more general, you know that we're also working on many other more novel risks, such as climate and environmental risks. And the interesting thing here is that actually these novel risks can interact. So if we're not doing enough to fight climate change, if physical risks related to climate change materialize, this can lead to migration, this can lead to tensions between states. So we also have to take that broader picture into account. I'm showing you a few slides where you can't read everything in detail, so I just highlight a few things, but this is kind of the way we're looking at these geopolitical risk drivers that are in some sense very different from traditional risk drivers. So they often come from outside of the financial system. As I said, they're less predictable, highly uncertain, both in terms of probability and impact. And overall, although we all like, of course, quantification, less subject to quantitative analysis, and this is really a big issue. So we have to deal with this uncertainty. But this doesn't mean we should stay away from analyzing these risks, because they very fundamentally affect the operating environment and the risk profiles of banks. And before I go into the transmission channels in some more detail, let me really stress this point about uncertainty. So we're really talking about radical uncertainty in this area, meaning we can't quantify these risks. And actually, market data is telling us that we can't quantify these risks, because here you see different measures of uncertainty in the euro area that colleagues have put together. And what you see is that actually political uncertainty, that's the green line, is rather elevated, but more market-based indicators of risk are pointing downwards. So there's this disconnect, and you see it in many time series, and you hear it when you talk to market participants. They would tell you that it's just hard to price geopolitical risks, and this is why it's often not done. Okay, so then we tried to become more practical and to see how geopolitical risk really affects the traditional risk drivers, and it's actually a variety of transmission channels. So again, apologies for the slide to be difficult to read, but this just tells you how many transmission channels and mechanisms there are, how geopolitical risk is affecting banks. So on the bottom of the page, you see the traditional risk categories, which of course don't change: credit risk, liquidity risk, market risk, and so forth. And then we've identified 3 channels. So the first is the financial market channel, and that's pretty much related to the evidence that I've just shown to you, namely that at the current juncture, geopolitical risks are not priced on financial markets. And we know, again, the work that also economic historians have done is very insightful. We know that once the market sentiment switches, then very suddenly we can have a repricing of risk of assets, which also very severely affects the market and funding risk for banks. Second channel is the real economy channel. So this is trade disruptions, interruptions of supply chains, which can have all the negative implications, of course, for the real economy in terms of inflationary pressure, in terms of changing patterns of consumption and corporate behavior. But again, the banks are affected. The banks are affected through credit risk, heightened credit risk. And the important thing is that the effects very often differ across sectors, depending on how interconnected the firms are, depending on how dependent they are, for example, on energy supply. And I think this is something that is often not captured well in aggregate GDP developments, which is something that we also need to take into account when we look at stress tests and how we do stress tests. And the third channel is the safety and security channel. So this is, if you want to think about it, it's very much related, of course, to cyber risk. Third-party outsourcing is a very important area here, and we're also doing a lot in that space. And then what complicates the picture even further is that once geopolitical risk events materialize, there's often policy responses that then can affect the banks. So financial sanctions would be one area to mention here. And importantly, and this is also where we work very closely with the banks, it is not just the globally active banks that are affected by these channels. So it can also be a very local bank that has some type of outsourcing agreement that is affected by these geopolitical risks. But at the same time, it's relatively difficult sometimes also for the smaller banks to take this geopolitical risk into account in their own risk management. So one reason I've mentioned already, if the risks are not priced on markets, then of course it's also difficult for the individual bank to take the risk into account in its own risk models. But then very basically, it's just costly to monitor all these transmission channels and to understand what is important for a particular bank. And then another very practical reason, some of the events might materialize after the typical time horizon for the capital planning for a bank, so after 1 to 3 year time horizon, but still have a very detrimental impact on the business model of a bank. So this is where we come in. So where supervision, I think, has a very important role to play in terms of understanding the transmission channels, addressing weaknesses that we very often know in banks' risk management and stress testing. Of course, then if we identify weaknesses, if we have findings, we also look for remediation measures, so we take supervisory measures. And we also can coordinate a bit across the banks, because we can compare many banks. A very good example is the cyber resilience stress test we did this year, which I think my impression was that also the banking industry was really found it very useful, because it also allowed to give best practices and information of what works. So micro supervision clearly, and I will give some more example, has a very important role here to play. But of course, we're talking at a conference about macroprudential policy. Let me switch over this one. About macroprudential policy, and as I said, we really need to cooperate closely, because we're all looking at the same financial system, and if the supervisors don't address the risks in the individual banks sufficiently, then macroprudential policy has a problem, and vice versa. If macroprudential oversight and policy does not take sufficient measures to address risks to financial stability, then it's also very difficult for the microprudential supervisor to deal with the issues. So we, of course, and again, I will go a little bit into more detail of what we very concretely do right now in the SSM with regard to microprudential policy. We, of course, use all our instruments and are also very concrete in terms of breaking down the transmission channels of geopolitical risk into our concrete activities. And just to mention two, I think, particularly important areas for macroprudential oversight. One is, of course, the counter-cyclical risk buffer, and in particular the positive neutral level of the CCYB, which I think can get us a long way forward in terms of addressing also uncertainties about the financial cycle. A lot of thought has been put into how do we best measure the financial cycle, but of course there's uncertainty, but also uncertainty in the sense that I've been discussing here. But of course not to forget about structural risk, and so we also need the GSIB and OC buffers, of course. But again, my main point here is that we do have this high level of uncertainty, and only by working together, sharing information and taking action, we can address these issues. So what do we do more concretely? As I said, we followed, if you want, a three-step approach. So we started from the transmission channels that we have identified, and I should say, if you have any comments on this after this conference, just feel very much invited to send them to us. So this is also work in progress, and let us know what you think about it. So we identified the transmission channels, then we mapped them into our existing supervisory initiatives, and we gladly found there's actually a few initiatives which exactly help us to address geopolitical risk. And then, of course, whenever needed, we also identified gaps. And the 5 initiatives I briefly want to talk about is, first and foremost, strong governance structures in banks. And I think this is particularly important in an environment where you need a lot of judgment, experience, where you need to put together qualitative and quantitative information, where you need to do scenario planning. This is really where a strong governance in banks has an important role to play. These are all important tasks that you can't delegate, and we just issued a new ECB guide on banks' governance and risk culture. So this is out for consultation, and again, whenever we put something out for consultation, we're also happy to get feedback. And this importance of governance and risk management, as I said earlier, it's not just for the large banks where it's quite obvious that they deal with geopolitical risk, but it's really also about smaller banks who might depend on critical infrastructure and third-party providers. Second focus area for us is capital and liquidity planning. So we are also in a very intense dialogue with the banks when they do their capital and liquidity planning, the ICAPs and ILAPs, if you're familiar with these acronyms. And we also see how banks are addressing geopolitical risk scenario in these capital and liquidity planning, and we interact with them if we feel that these risks are not sufficiently taken into account. I mentioned the credit risk channel, the real economy channel, where I think it's crucially important to look at underwriting standards, so to make sure that future risks are properly priced. So this is certainly an issue that we pay a lot of attention to. And also, given the uncertain nature of geopolitical events, it's important that in the provisioning practices of banks, this uncertainty is taken into account. So it's another manifestation of, you cannot simply use the existing models, but one needs to make sure that also this uncertainty about the future is taken into account. And many of the potentially adverse events you just don't see in historical data, so there's also an issue about the data that is available that goes into provisioning and also credit risk assessments. And so there's one tool or instrument that banks can use to address this uncertainty, and this is accounting overlays in their provisioning practices. So this was a tool which was used a lot during COVID times, and we generally encourage the use of overlays, but we also stress that overlays need to be based on sound methodologies and governance. And we did a survey of how the banks are using their overlay practices. Most of them are using overlays to address novel risks more generally. So it's not just about geopolitical risks, it's also about climate and environmental risks. So most of them are using them, some with outdated models. Then we would, of course, get into a conversation that the models need to be improved. But some are also ignoring these novel risks. So that's, of course, where we would pay then even more attention from a supervisory perspective. The second element here is stress testing. So I mentioned that, of course, the standard stress test where we have a severe GDP shock and we test the resilience of the banks gives us information about the resilience of banks. And the last EBA stress test was designed such as to take an adverse negative geopolitical risk scenario into account, and the banks were found to have sufficient capital buffers to withstand such a severe negative scenario. So that's certainly good news. But we also all know that the standard stress testing approaches have limitations when it comes to capturing the complexity of geopolitical risk. So that's why in the next stress test we will pay more attention also to counterparty credit risk and to address this in our scenario analysis. Fourth point, operational resilience and cyber risk, also mentioned by the President. So a key area for us and also a key area of concern for the banks we talked to. So that's why we conducted a cyber resilience stress test. So this was not about the prevention part, it was about how do banks react, respond once a severe cyber attack has hit them. So that was the scenario we designed. We found that the banks were prepared, so this was certainly the good news, but as with any of these activities, you also find that there's areas for improvement, and we follow up upon these areas with the banks, also in our standard SREP process. And clearly what I think is also very important to bear in mind when it comes in general to digitalization, IT transformation, cyber risk, of course the necessary budgets need to be there in the banks to also finance this, because it's to finance the investments into resilient IT infrastructure. Just one small remark on the outsourcing, not that it's small, but just to let you know that we're also doing, of course, in coordination with the ESAs, with the European Banking Authority, we're doing a lot to start the work on DORA, so the Digital Operational Resilience Act, which allows us to have an oversight function over outsourcing agreement. Last but not least, clearly we look, talking about geopolitical risk, we also need to look specifically at regions where geopolitical risk events have materialized, and we did a very careful vulnerability analysis of banks' exposures to Russia, and we follow up, of course, with the banks that have exposures there and take supervisory action. But just a recent number, the banks overall under the SSM have reduced their exposures by 56% from the outset of the war until the first quarter of 2024. Okay, let me conclude. Clearly here this is my last point, we're talking about an area where we just can't, also with all the best institutions that we have in Europe, but we can't deal with this issue of geopolitical risk alone. To some extent, and the President has also given a speech recently about the similarities but also differences between the 1920s and the 2020s. And as we all know, in the 2020s, there was also a series of shocks hitting. And after that, the world economy has basically closed down. So there were capital controls, trade restrictions. When we're speaking about banks, also activity restrictions for banks. And it has taken decades to reverse that trend. And we clearly are not saying that we are there, and we clearly don't want to be in a situation where this is happening. So we want to keep markets open, but that also means we are exposed to shocks from abroad. So even more so, we have from a micro and macroprudential perspective, we have to do everything that we can, that the risks that this carries with it, that they are well managed. We can't do this alone. We need also strong cooperation with the Basel Committee, with the Financial Stability Board. And I think this is particularly important because we do have a period of heightened geopolitical risk, and I don't think this is going to disappear anytime soon. It would be nice if it was. And I think all stakeholders have a role to play. So it's, of course, the financial institutions that have to address vulnerabilities that are sometimes also known, and we've addressed them with them to make sure that they prepared for the unknown and that they can defend their business model. regulators by also resisting the pressure to relax regulation and by maintaining a framework that ensures resilient financial institutions globally, and clearly supervisors. We need to ensure that the banks remain resilient to geopolitical risk, both financially and operationally, because a lot of the risks we are talking about are really about operational resilience, and this will clearly remain a priority for the SSM. Thank you very much.